Welcome to Unit 3.9 Budgets, specifically designed for higher-level students. In this unit, we will delve into the intricacies of budgeting within a business context. In this section, we will analyze and apply the differences between cost centers and profit centers, and understand their roles within a business. Tracking finances in a large business can be challenging. To manage this, businesses are divided into logical departments known as cost centers and profit centers. Each manager is held responsible for their respective department. A cost center incurs costs but does not generate profits. The manager monitors these costs within the department, ensuring they are aware of how their expenses impact overall profitability. A profit center incurs both costs and profits. The manager is accountable for the profitability of their specific department, balancing expenses with revenue generation. Cost and profit centers offer several advantages, including accountability for managers, identification of weaknesses, fostering team spirit, encouraging competition, benchmarking, and rewarding performance by department. However, there are also disadvantages, such as the difficulty and subjectivity in allocating indirect costs, time-consuming and expensive data collection, tension between centers, stress for managers, and performance often being beyond management's control. Next, we will analyze, apply, and construct a budget, understanding its importance in business decision-making. A budget is a financial plan for the future, which may include revenue and expenditures. It can cover the entire organization or a single department and is usually defined for a fiscal year, but can also be monthly, quarterly, etc. There are various types of budgets, including sales, staffing, production, and marketing budgets. Each type forecasts different aspects of the business, from sales numbers to staffing needs and marketing expenditures. Budgets can be set using historical data, known as incremental budgeting, or through negotiations, known as zero-based budgeting. Other considerations include organizational objectives and competition's actions. Incremental budgeting uses last year's figures as a basis. Managers must justify any changes for the new year. While it is less time-consuming, it can lead to complacency as previous spending is often taken for granted. Zero-based budgeting starts from zero, requiring departments to justify every expenditure. This method ensures all spending is scrutinized but can be time-consuming and frustrating for employees. To construct a budget, start by estimating revenue and identifying all income sources, such as product sales, services, and subscriptions. Use past sales data or industry benchmarks for projections, and be conservative, considering seasonal changes and market trends. Next, list fixed and variable expenses. Fixed costs remain the same each month, such as rent and salaries, while variable costs fluctuate with business activity, like raw materials and utilities. Include one-time and unexpected costs in your budget, such as equipment purchases, business licenses, legal fees, and an emergency fund. Typically set aside 5–10% of revenue. Finally, we will analyze, apply, and calculate variances, understanding the importance of budgets and variances in decision-making. Let's evaluate a sample budget plan for a business selling popcorn. Compare the budgeted figures with the actual outcomes to see how well the business performed. The difference between the budgeted figure and the actual outcome is known as the variance. It can be favorable or unfavorable, and if unfavorable, managers can determine the cause and take corrective measures. A favorable budget variance is financially beneficial to the organization. For example, if actual costs are less than planned or actual sales exceed budgeted sales, the variance is favorable. Unfavorable budget variances can be financially detrimental to an organization. For example, actual costs may exceed what was planned. In marketing, if actual costs are $220,000 but the budget was $200,000, there's an unfavorable variance of $20,000. Similarly, if sales revenue was budgeted at $500,000 but actual sales are $410,000, the unfavorable variance is $90,000. Investigating the causes of unfavorable variances is crucial. Overspending might be due to reasons like supplier cost hikes after the budget was set. These variances serve as warnings to the business, indicating rising costs or falling revenues. Corrective steps must be taken to address these issues. Let's examine the May Visual Arts Company. The table shows actual values, budgeted amounts, and variances for different categories. What is happening with each category? Now, let's look at the Walk Express. Complete the missing figures in the variance column and determine whether the variance is adverse or favorable. Here are the answers for the Walk Express. The table shows the budget, actual values, variances, and whether they are adverse or favorable. At Laptops R Us, the table displays budgeted and actual values, along with variances and their percentages. Remember, A stands for adverse, unfavorable, and F stands for favorable. Budgeting is important for financial planning. Pauline wants to visit Rome during spring break, which costs $15 million. She earns $2 million per week from her part-time job but spends around $700,000 weekly. With 10 weeks until break, can she afford it? How can budgeting help? Setting budgets offers numerous benefits, including planning and guidance, effective resource allocation, setting achievable targets, coordination, monitoring and controlling, modifying, and assessing performance. Despite their advantages, budgets have limitations. They lack flexibility in a fast-paced world, focus on the short term, can lead to unnecessary spending, are difficult and time-consuming, and unforeseen changes often occur. Managers may also inflate estimates to meet targets.